Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to us by EQ Derivatives. And the topic today is index spread strategies. I'm very pleased to have with us this afternoon Russell Rhodes, who is a highly regarded strategist, educator, and consultant, among other things, during his 25-year career. He also sneezes. Bless you, Russell. By the way, he's also perhaps best known, especially to interactive broker audiences, for the decade he spent delivering webinars as the Director of Education for the CBOE Options Institute. In addition to his current duties as head research consulting at EQ Derivatives, Russell is also a professor of finance at Loyola University and is currently pursuing a PhD from Oklahoma State University. So with that, if you would all join me in welcoming Russell, I'll pass you those controls, Russell, and let's go ahead and if you can share your screen, we'll get underway here today. Thanks for joining us, Russell. Always good to have you.
This is always my really nervous moment. Can you see that?
Yes, we can. If you can put it into slideshow view, perfect.
Is that it now?
Well, no, I think you're still in presenter mode.
How about that now? This always makes me really.
There you go. Now you have it.
Yeah, this is we're a decade and we're still a well-oiled machine, Cynthia. Okay.
We do it well. Thanks, Russell.
Thanks. And somebody just popped up and said no audio, so make sure you can. Scott, can you hear me now? Here's my disclosure. I'm here for educational purposes only. I try to throw ideas out there for people to kind of run with. And in this webinar, I'm not showing any past back tests on things, but I have in some other ones. I do think I'm going to move forward with some back testing with some of the work that I did for this webcast. I'm going to talk about the three indices real quick and take a look at, I'm going to take a look at how the three indices, how do they move around relative to what options priced in? And whenever I do something with interactive brokers, I like to come up with, I put a lot of pressure on myself and I try to come up with something new or, something that I can, that I can share that maybe people can go ahead and work with, and something that maybe I can do some extra work with as well, and then maybe come back in a month or two or write something up on the EQ Derivatives website. So I just got still no audio from Scott. If I could get a Y from anybody that maybe can hear me, just so that I know I'm not just talking to me and Cynthia. There you go. Thank you, guys. So the S&P 500, the index, and everything I'm going to talk about today is really index option oriented. Each S&P 500 option contract, the notional in those gives you exposure of about $36,000, $37,000 of exposure to the S&P 500. And these notionals would come into play when we consider doing one index versus another. We have Monday, Wednesday, and Friday expirations. On the third Friday of each month, there's actually two Friday expirations, the AM and the PM, and these are marked very, very, you can see this on the Interactive Brokers platform. I've come close when I wanted to trade the PM option to trading the AM option by accident once or twice, but there's a real, you can see which one you're taking a look at. And personally, I like the PM settled option contracts, which are the majority of the expirations. That AM settlement, back when I used to go around the country and talk to groups, and I'd take a brief survey and I'd say, how many people have been burned by AM settlement? I always get a dozen or so people that raise their hands. So those PM settled options, what you've got at the end of a trading day. You don't have any overnight risk there. And of course, the volatility index for the S&P 500 is the SIBO volatility index. I'm going to talk a little bit about the three respective volatility indexes as well. The NASDAQ 100, these are really big options. The at-the-money notional is almost $125,000 just because the index is quoted at such a large number. There are smaller versions of the NASDAQ 100 options. that can give you less exposure. Also, anytime I talk about a NASDAQ 100 strategy using the NDX options, it transfers over to using the QQQ options, which are a lot more palatable for a lot of folks, and I understand that. Now, the volatility index for the NASDAQ 100 is something that it's VolQ is the ticker. Cynthia and I have been lobbying the folks at Interactive Brokers, and you can get VolQ on your IB platform now. This is the first time I think I've done a webcast that VolQ is available. Now, something that you need to know with respect to VolQ relative to VIX or the Russell 2000 volatility index is VolQ focuses more on at-the-money options. All three of them look at a 30-day time period, but VolQ, it gives you, it disconnects from VIX in that it's focusing more on at-the-money option contracts, and whereas VIX is looking at a big strip of options. So when you compare the two, you're really comparing at-the-money NDX volatility to a wide range of average volatility on VIX. And because of that, VolQ is probably a couple of points lower on average than VXN, which is a VIX version that uses NASDAQ option contracts. And then finally, the Russell 2000, the most volatile of these guys. Unfortunately, there are not as many expirations available. I poke the folks over at SIBO every once in a while and say, let's add some Mondays and Wednesdays just so we can do some more strategies. You do have Friday options. They're PM settled except for the third Friday. They also do have end of quarter options, which I kind of like, especially targeting the last day of a month when I'm looking at calculating performance. And the volatility index for the Russell 2000, that's quoted under RVX, with the exception of about 24 days. The Russell 2000 implied volatility has been at a premium relative to VIX since, I believe, 2004, which is how far the data that we have goes back. Now, what I did was I was looking around for, how well do the options on each of these indices, how well do they do as far as predicting the subsequent volatility? And we can take that a step further and say, are there options that are more likely to underprice or overprice the index? Raman just asked, what's the difference between VXN and VolQ for NASDAQ? VXN uses a strip of options. VolQ uses at-the-money options, but both of them give you 30-day volatility measures. So that's the difference between the two. So what I did here for when I was looking at implied volatility versus realized volatility, you can actually get 10-day at-the-money consistent implied volatility from Bloomberg for each of the indices. So I did that because it's the same calculation for all three of the indices. And what I did was whenever there were 10 calendar days between a Tuesday close and a Friday close, I would actually, I would calculate where did each of these indexes fall relative to the implied volatility prediction to the index 10 calendar days later. So what I did was I took that 10-day implied volatility measure from Bloomberg. I used a calculation to figure out what the predicted range was a week from Friday, which would be 10 calendar days in the future. And I looked at how often would each of the indexes fall outside of that range and how often did they fall inside of that range. And I found something I think is kind of cool with respect to that. Not all index options are the same, I guess is the best way to put it. So I look at the 10-day implied, and I used all of the numbers going back to from 2005 to 2020. And this gave me about 350 or so observations. I threw out all of the holiday weeks. And what I did was I looked at, okay, what's the 10-day implied volatility? What's the highest it's been, the lowest it's been, and what was the average? And this is not the volatility indices. Again, this is 10-day implied volatility. Much wider range. The average is a little bit lower than each of the 30-day volatility indices. But these numbers were kind of what I expected, that SPX would be lower than NDX. And I just know through experience that the Russell 2000, even though it's got more stocks, it's got more small cap stocks that are a lot more volatile. And the realized volatility is typically higher on the Russell 2000 than the other two. And that shows up in the implied volatility as well. I believe all three of those max numbers were in March of this year, if I remember correctly. Now, what I did, as I mentioned, it was 594 observations, actually. What I did was I took each of these 10-day implied volatility measures, again, adjusted them for what is a 1 standard deviation move, and then took a look at how often were we inside the range, and then how often were we outside on the downside? How often did the market sell off more than was being predicted by the option prices, and how often did we rally more than was being predicted by the option prices? And a couple of things really caught my eye with this. The first thing is, and let me see if I can, cool, spotlight. First thing's right here. The fact that I was really surprised that I expected all three of these numbers to be very similar. And basically, the SPX and the Russell 2000 numbers are in line with each other. However, the NDX numbers, it's an outlier, and I think a significant outlier. So you're more likely to have a move over a 10 calendar day period that is larger than what options are predicting out of the NDX when compared to the S&P 500 and the Russell 2000. And generally, what I would take from that is, and I would never suggest just buying a straddle, but if you were thinking about buying an at-the-money straddle, trading an at-the-money straddle, you'd probably, believe it or not, you probably want to do it with NDX options instead of S&P 500 or Russell options. Stephanie, I see the question. I'll get to that one at the end, I promise. So that's a good question too. So that was kind of my first finding here. The second one related to all three of them, and more so with the S&P 500 or the NASDAQ, but you were much more likely to have a move to the upside than was greater than what's being predicted by at-the-money options than the downside. And this is counter to the old Wall Street saying, we take the stairs up and the elevator down or whatever, but we tend to move up slower than we move down. I think this is kind of surprising. And I've heard this anecdotally from some smart folks that are very that really like to trade iron condors. They say they seem to get blown up to the upside more than the downside if they're consistently doing iron condors, and maybe that's what's showing up here as well. But you're more likely to see an upside move that is greater than what's being priced in by the options than a downside move. So the two takeaways really were short term. If you're thinking about getting long volatility, NASDAQ options might be the way to go. You've got a higher likelihood of a move that is bigger than what's being priced in. And if you are, if you're thinking about a move to the upside, option strategies might make more sense than a move to the downside. And I really do think that is counterintuitive to what a lot of people would think. And the question about the right here, just about would skew. Well, I'm only using at-the-money options here. So there would be, and we'll see that in a couple of strategies in a minute, because you do have higher implied volatility for out-of-the-money puts versus out-of-the-money calls. But the at-the-money put and the at-the-money call have basically have the same implied volatility. I actually pulled both separately. And it says, are these 10-day standard deviations or one standard deviation? This is a 10-day one standard deviation move. So, so there we go. Wow, I'm getting good questions today. This is why I like doing interactive broker webcasts. I'll be like on fire all day. So and then these are 10 day. Yes, this is the predicted 10-day move from the option contract. So after I went through that, so I started just taking a look at some trades. I'm going to go through some block trades real quick, and then I'm going to start answering all the questions that are popping up. So there you go. And I have been repeating the questions. So back in October, we got a block trade, and we just somebody came in with the SPX right there at 35.11, and the at the money implied volatility was around 1942. This translated to an up or downside move of 33.99, comes very close to 3,400, or an upside move of 36, let's say 25, because that's the strike prices that I'm going to use. And I was digging, Diego, I don't quite understand the question there. This is a one standard deviation price move right here. That's a one standard deviation price move over a 10-day period. So I came across somebody that actually had put on an iron condor that was on that date that expired 10 days into the future. And basically one trade that was put on here was selling the 3,400 put and selling the 36.25 call. And right here, I got the question about skew before. You can see it right here. We've got a $14 option that is one standard deviation down and one standard deviation to the upside. You're seeing a price of $6.90. So you can totally see that the difference between the two, the implied volatility differences, show up in the option premiums there. But when you start to put on a trade and you're also going to sell an option to help cover the cost of some of the options, well, right here, this 10-point spread here, this option was only $1.25 cheaper. So whereas right here, it's only $1.30. So even though there's skew showing up, when you get that far out on the curve, there's not a big dollar difference when you start looking at equidistant strikes relative to each other. Somebody came in, put this on, net credit of 255, really nice, wide range on this trade. And if I remember correctly, I believe that we landed close to one of the strike prices on this one, but came out, I think, around here or so, but didn't overshoot over the life of the trade. Now, I've got a buddy. I think some people have heard the Option Insider Network before, and the guy that runs it, this guy named Mark Longo, he says a lot of interesting things about different people's attitudes toward trading, and he talks about how iron condors are iron butterflies for wimps. That's his word behind it. But also, he feels like on a regular basis, you can do better doing an iron butterfly than you can with an iron condor. Now, you're not going to make the maximum profit, but you have a likelihood of doing better if you get a very neutral move out of an underlying market. So what I did was I just replaced the at-the-money option contracts with the or the close to at-the-money option contracts with the with where the previous one standard deviation strikes were sold, and the result here was taking in 50.70 on the 35.10 put and taking in 47.30 on the 35.10 call. And taking a really nice credit of 79.65. I just stuck with the other two long strikes, which actually makes this a slightly imbalanced iron butterfly. But kind of sticking with the same sort of outlook. Get a, just a wider range, a bigger potential dollar risk, not necessarily when, not necessarily, a less risky trade, definitely a little bit more risky trade, especially if we get a big move to the outside and a narrower range of potential profitability. But one of the great things about index options is the cash settlement. So you can actually hold this guy through expiration and you don't have to worry about having a position in the SPY ETF come Monday morning if you held this one into a Friday. So I think a lot of traders that consider iron condors on a regular basis, and I did a webcast where I tested out a method of trading iron condors on the NDX, and I think that one's recorded for Interactive Brokers right now. And I did the same thing using iron butterflies, and the profitability actually went up. The drawdown went up, but the profitability went up as well. So switching over to NDX, the NDX going back to August 18th. That's another trade. I looked at Tuesday trades and tried to find some block trades that seemed to match up with the 1 standard deviation move. Now the 10-day at the money implied volatility on August 18th, it was 2286. You take that, you can convert it to a 10-day 1 standard deviation move, a 10 calendar day 1 standard deviation move. That's up or down at 431.32 points. So the downside is 10,967 and the upside's 11,830. Doesn't that look really wide? But we did just see that you've got a higher likelihood of the NASDAQ breaking out one way or another than the other two trades. Now, I am not a fan of the long straddle. I've traded one long straddle in my career, and I made $50, and I said never again. So I'm batting 1,000 with the long straddles. It was earnings play that I saw was underpriced, and the option, I think the whole trade cost me like $70. But I'm not a big fan of this. I'm a big fan of doing something like this and then selling some options to narrow things down a little bit. But in this case, buying the at the money put and at the money call, we have a net cost of 334 with the NASDAQ right. It was right at 11,399. So net cost for this straddle was $334, and you've got a break-even level up around 11,750 and down around 11,050. But you've got to have a lot go right to make money off of a straddle. So one of two things I think that you do when you're thinking about trade, if you put a long straddle on, you might want to consider planning on trading around it and scalping around it a little bit. So that's just that's just something I definitely would take into account. If I were to do something like this and the first day I got a big move up here, I might, even though there'd be, let's say first day I got a move right here, I'd probably consider selling, whatever a shorter dated, and you got Monday, Wednesday, Friday expiration, a shorter dated NDX option and taking in a little bit more premium, or maybe even selling this side of the straddle, depending on how much of a profit I have made off of that leg. However, I would really rather do something along these lines. And I took a look at and I saw the straddle, but I added the wings on my own here. And the net result was taking the cost down to 262.50. And by taking the cost down to 262.50, I was actually able to end up with a fairly narrow range of where we could start to make money off of this trade. And one thing that I did experiment around with and just didn't make it into the webcast was I took a look at right here, and a lot of the things I'm talking about, I'm gonna back test and see how they worked out consistently. But right here, because we did see back on the table that these trades have a higher likelihood of breaking out to the upside than the downside, maybe you don't sell the call. Maybe you just sell the put. And, you know, one of those old allow your profits to run type things. But if we've got a higher likelihood, then instead of doing the butterfly, maybe buying the straddle and only selling the put, which is a pretty popular trade in the VIX arena, maybe applying that to indexes might be something to do some work on as well. And so that would widen the wings out a little bit, but allow us to move to the upside a little bit more. Oh, and then finally, I had a hard time finding the poor Russell 2000. I think it's a great index to trade. I had a hard time coming up with a good trade here. So I basically had to fudge around coming up with a trade a little bit on my own, which was unfortunate. But 10-day at the money, implied volatility back on August 18th, and it says NDX. I always find one of these. It says NDX. That should say RUT. 10-day at the money, 35.54 implied volatility. You convert that, gives you up or down 88.5 points basically. So we got downside of 14.16 and upside of 15.93. I just because things kind of tend to run more to the upside than the downside, I just took a look at an out of the money bull put spread or a credit spread using puts, and I was able to come up with a credit of $1.10 on that, with something that you don't think you're going to get. You think you're going to get run over maybe one out of 10 times or so. Over the long term, this would probably make sense as a consistent trade. I do know if you add a trend indicator, maybe if you only put a trade like this on when the Russell 2000 is above something like the 20-day moving average, that the win percentage on something like this goes up to about 95%, just from, again, some work that I've done in the past on that one. So, and there's what this trade looked like. Got that one standard deviation move to the downside on the bull put spread. So I got a lot of really good questions, and I wanted to show some trades, but I really wanted to talk a lot, and there are a lot of questions with respect to this, about what's on this table right here. And I'm gonna start working through some of the questions here. Inside the range, how much of a deviation? So Matthias had a good question saying that are the NDX options overall priced correctly and the SPX and RUT options are too expensive? Not necessarily. And I know that and I think where you're going with that is the one standard deviation move is about 66%. It's about a 2/3 price move. And that's what we're seeing with the NDX options. But because the outlier moves can be bigger losses than the gains that you can make falling within the range, you actually expect the underlying market to fall within a one standard deviation predicted range a little more than 70%, in the 70 to 75% range. So I know, I believe that's what you're asking, is that 66.84%, is that saying that those are priced perfectly? Personally, I just think that it's an indication that if we got a big volatility, if you think the first quarter of 2021 is going to be extremely volatile, you might want to look at getting long volatility with NDX options as opposed to SPX or Russell 2000 options. You've got to consider a price forecast and a lot of other things that come into play. But whenever I run numbers and I see something that doesn't make a lot of sense or looks like something you would not expect, first thing I do is I rerun my numbers. And then after I rerun my numbers, I'm like, well, that's definitely something that people should take into consideration. So, even though implied volatility on the NDX options is typically higher than on the SPX options, this can actually be taken as NDX options are cheaper on an implied volatility versus historical versus subsequent realized volatility basis. So I think I hit on that one a lot. So Stephanie was asking about the advice on when to place an iron butterfly versus an iron condor. Really has to do with the risk reward and the certainty that you have with respect to a trade. That's really how I like to think about that one. Is if you really think things are going to be narrow, an iron condor or an iron butterfly makes more sense. Excuse me. If you've got less certainty, the iron condor may make a lot of sense. I think when we have a really, if you think volatility is more, overpriced, I actually think you should be going with the iron butterfly because you're going to fall closer to the midpoint of the range that you end up with. I used to work at SIBO with somebody that wasn't the nicest guy sometimes when he answered questions, and he'd always go, "Well, it depends," and blah blah blah. Well, and I don't want to say it like that and it come across negatively, but it does kind of depend. What do which one matches up better to maybe the price forecast that you have out there? So I'm just trying to, got a lot of questions, which is great, absolutely great. So Stephanie, I think I got the question on the skew just when I showed the option prices. I felt like that would show up there. I just saw a question about vol Q versus, so Jeff, this is a really good question. And Jeff is, and I'm gonna start working backwards on questions. Asked about, Tesla going into the S&P 500, and will that have an impact on the relationship between VIX and vol Q? And I'm gonna guess the answer would be a little bit. Not a whole lot, but a little bit. It will add to the volatility of the S&P 500, but it is such a big component of the NASDAQ that it's going to continue to have a big influence on vol Q relative to the influence that it might have on VIX. Also, keep in mind, vol Q is calculated with, I believe, only 16 option contracts. It takes closer to at-the-money options that are just outside of at-the-money for a couple of expirations to come up with a 30-day implied volatility measure. Whereas SPX is a strip of options, and the movement of out-of-the-money option contracts can have a bigger impact on VIX than it does on vol Q. In fact, that's really where the big disconnect is between the two, is not necessarily the underlying index, but the correlation of vol Q relative to VIX is lower than the NASDAQ 100 volatility index that uses the VIX methodology. The VXN and VIX have a higher correlation than vol Q and VIX, and I think that's has more to do with the calculation of the index versus the components that are in each of the indexes. But I do think that Tesla going into the S&P 500 probably will have a little bit more of an impact on VIX than we see right now. Jeff was asking if I posted slides about any of the trend following research. Jeff, send me an email. I've actually written a paper about that I have to find somewhere. I'm not sure where you can find it because it's a little dated, but I have done some work around what kind of strategies work well in different environments. Mark's asking, is there a data vendor that I recommend? I use Liveball from SIBO. There is a lot of manual labor that goes into some of the back testing that I'm doing. I also use Bloomberg sometimes as well. I know that's a little pricey for folks, but in my position as a professor at Loyola, I actually have access to a Bloomberg, and I also have access to undergraduate students who are always interested in helping me out with some of these strategies. So I'm fortunate I've got some enthusiastic, cheap labor that helps me with those types of things. If you have something you want me to look at, a lot of, probably half the webcasts that I've done for Interactive Brokers comes from that type of work that has come from questions from you guys. So you're more than welcome to send me something like that. Matthias, I see your question, but I'm gonna start working backwards for just a second. Let's see. So I had the question about the minis versus the micros and the options versus the futures. The minis versus the micros, those are the futures contracts that the mini is the one that I think we all consider kind of the standard now. And the micro futures are contracts that are a tenth the size of those. So really small multipliers, which is kind of nice. So for instance, if I don't have a whole ton of conviction or just want some long exposure, I've been using the micros. I've been using the micros to test things out as well. But also I've been spread trading the Russell 2000 versus the S&P 500 futures. And there's about a 2-to-1 relationship, but the micros make it really easy to get dollar neutral when you trade those two things against each other. For outright directional trades, I prefer using the minis or the micros, just depending on what kind of conviction I have there. Options, I want to take a little bit more into account. What type of moves being priced in by the options? What type of move do I think is being priced? That do I think should be priced in by the options? The only way that you really make money on an option trade is if your opinion is differing from what's being priced in by the market. So, I could probably write a whole book on when you trade options versus futures, but I think at a very high level, that's kind of the way to think about both of them. I got that question. So I apologize. I'm not sure on the micros or minis. I always wrote about the question was, do the micros and minis settle in cash? I'm not really sure because I tend to roll my positions. In fact, we're getting close to time for me to roll my December positions to March. Several experts. At what time an option actually expires on expiry day and received at least 7 different answers, ranging from 4 o'clock to the end of extended trading hours. Okay, the Saturday is not true anymore. One of the comments in here was, and even the Saturday after the Friday expiration. Saturday after the Friday expiration used to be standard option expiration. And that was kind of an operational thing where the options would stop trading on Friday, gave us a day to settle everything. Well, technology came around and now they technically expire a few hours after the market closes on Friday. And that is to give you the opportunity to exercise an option that you might not have wanted to exercise or would not automatically be exercised, or choose not to exercise an option that would automatically be exercised. If you had an option that was a penny or two in the money and you didn't want to exercise it, there's a way that you can go about speaking to your broker and making sure that happens. I think what you really need to know with respect to the option contract is the option contract, and this is really for stocks, but the option contract is going to be settled based on the closing price of the stock at the official, at the exchange that it was listed on. So for IBM, it would be the closing price at the 4 o'clock closing price at the New York Stock Exchange. I'm pretty sure that that's the way that it works for all the ETFs and all of the stocks. And you have an official closing price for the index, and that's the price that you need to worry about. Now, the expiration time is a little bit later, and actually, I'm sorry, Cynthia, but I'm going to mention there are other brokerage firms out there. Different brokerage firms have different cutoff times with respect to when you can tell them what you would like to do with an option that's in the money. So that might be why you're hearing different times as well. I heard a voice.
And if I could jump in for just a moment there, Russell, there is an options exercise tool that's available on the Trader Workstation platform, and you can find out additional information and specify your contra intentions. So as Russell mentioned, if you would rather have an option that's just a penny in the money lapse, you can do that on the options exercise tool. So take a look for that. Back to you, Russell.
You bet. Samuel, are we recording, Cynthia?
Oh, yes, we are. And
okay.
I just put in the questions panel a response and the link that you'll be able to access today's recording. It's underneath the education menu on the Interactive Brokers website. You'll find a webinar section where you can go and locate the recordings and industry sponsored tab. We'll have that up shortly after today's webinar ends if you do want to come back and revisit today's presentation.
Matthias is asking a question that we've got a webinar on the IB site that kind of does what he's talking about. He says, I'm interested in doing calendar spreads on the 3 indices. Volatility is currently low for 2020, but high for the last couple of years. Would you personally consider calendar spreads at the moment, or do you feel like volatility is too high to even consider them? Well, I was reading Ewan Sinclair's recent book. Now it wasn't. Sorry, don't strike that. I came across an old option book that talked about buying longer dated straddles and like buying a 1-year straddle and selling monthly options against that straddle, and or buying a strangle. It was a 1 standard deviation strangle that they purchased, and they were selling 1 standard deviation monthly options. And that way, if you had a big breakout to one side, you were protected. And what I did was I took that idea and I looked at buying a 3-month straddle using NDX strangle using NDX options, buying a 1 standard deviation strangle using 3-month NDX options, and selling weekly Friday 1 standard deviation options against it. And I haven't fully tested it, but what I haven't fully tested. I didn't fully test it, but I did it in a low volatility environment. I did it in a high volatility environment. And again, if you send me an email, I'll send you a link to it. I wrote it up in a report. It's available at EQ Derivatives. And we also did a webcast a couple of months ago in this place about it. And it was a really, really interesting strategy, and one of those things that I cannot wait till I get back in person with students to get somebody to do some more work on for me. So, but that, Matthias, I found that something like that at the very high level worked in both a high and low volatility environment. Let's see. I don't know what PMCC and PMCPs means. I got a question about slide 10. I'm trying to move myself here. Okay. Yes. So Raphael is asking, where did I get the calculation up or down? Up or down 112.89 points. So you can take implied volatility and you can convert it to a projected move percentage-wise and point-wise. And the way that you go about doing this is you multiply the implied volatility times the square root of the number of days that you're projecting, divided by the square root of the number of days in the year. And for this one, I did square root of 10 divided by square root of 365 and multiplied it by 19.42. And that gave me a percentage move. And then I multiplied that percentage move time, that percentage number time SPX to get that 112.89 number. If you email me, man, I'm just letting everybody email me. If you email me, I'll send you a spreadsheet that does it for you, because I know I just threw a lot of numbers out at you. Whoops, so I want to make sure I left that. I said data vendor. And actually, if I'm just looking at volatility of indexes and stuff, I use Yahoo Finance. Stephanie asked, do puts always have outside skew? The skew for index puts is always higher out of the money than it is at the money for broad-based indexes. We've never seen an instance where that's not true. So and since I don't work at SIBO where they would regulate everything I said, I can say always and yes. I don't have to use a hedge word there. So I think I've kind of gotten them for the most part. Did you see it? Sometimes, Cynthia, you see things that I missed, but.
Well, one thing that I do want to mention, there is a copy of the slides that's available in the handout pane. So if you want to take a closer look at the slides that Russell's been using today, notice if you simply double click that title bar, you can download today's presentation before you do exit today's session. So I did want to point that out.
I got a question from Lloyd. Lloyd, sometimes I use 252. If I'm looking at converting for a 1-day standard deviation move, I'll use 252. If I'm looking at anything that's past a week that's going to incorporate a weekend, I start to move over to 365. And I actually weighed which one to do when I started doing this work. And I just had and just decided to go with 365. But I actually have a spot on my spreadsheet where I can switch it from calendar days to trading days, depending on the time frame that I'm looking at. So, no problem. No problem. Oh, it's a great question. I probably should have said it up front. So, now we're moving slowly once again. I'd rather be here. I have to go to a faculty meeting.
Well, if there aren't any further questions,
nobody's saving me from the faculty meeting. Okay.
Looks like you'll have to endure. But I want to thank Russell Rhodes for a terrific presentation here this afternoon, and I'd also like to thank all of you for participating in today's webinar. Keep in mind that you can access today's recording on the Interactive Brokers website. And also, if you would like a copy of the slides, you can always send an email to webinars@interactivebrokers.com. So with that, we are going to conclude our session here this afternoon. Thank you all so much for taking time in your day to participate here with us. You can all exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, all, and much thanks to Russell Rhodes and EQ Derivatives for bringing us today's presentation. Thanks, everyone. Have a great rest of your day, all.